Let's say you're in a pinch. Your first instinct is to think of the worst case scenario and then work on mitigating the risk, right? That's risk management in a nutshell. Risk management is the process of understanding the potential risk, quantifying it, and reducing it to an acceptably low level. You can never avoid risk in life or in trading, but what you can do is fixate your risk tolerance levels and respect them each time you trade. If you're entering a position without first knowing where to exit, i.e. your stop loss, you can end up losing much more than you can bear. The risk while trading stocks is basically the difference between your buy price and your stop loss price. That is the maximum amount you can lose in a trade. Let's take the help of the stock chart mentioned above. Now, this chart shows a consolidation pattern or a parallel channel between the resistance and the support bar. When the breakout takes place and you enter the market on the retest, your stop loss will be below the blue support bar. As shown by the big red rectangle, the difference between the blue resistance bar and the blue support bar is the risk you're taking per share. In this case, you're taking the risk of 183.05 per share. Risk to reward ratio. Let's now talk about risk to reward ratios. You have to consider all the factors when trading stocks, and that includes your risk appetite as well. The reward for taking risk is the return that you're going to earn, and if you can manage to get a decent risk to reward ratio, you will be easily profitable in the long run. Let's consider an example here. The table below shows how an increase in your risk to reward ratio drastically reduces your required win rate to stay at a no profit, no loss level. Now, we've assumed that we have taken a total of 100 trades and our risk per trade is $10. If our risk to reward ratio is 1-to-1, we need to achieve our target 50 times, or 50%, to maintain our break-even point. If we're losing in 50 of our trades, then our loss is 50 multiplied by risk per trade, which comes to $500. And our profit amounts to $500 as well. Similarly, if our risk to reward ratio is 1-to-3, then we need to win or achieve our target 25 times to maintain our break-even. We need to win fewer times because, as compared to when our risk to reward ratio was 1-to-1, we now have lesser risk and a chance for a higher reward, through which we can even make decent profits if we don't overplay our hands. However, for the sake of this example, we're just discussing the win rate required to mitigate our risk and maintain our break-even position. When the risk to reward ratio is 1-to-3, our loss will be 75 trades multiplied by $10. And profit 25 trades multiplied by $10, which is our risk per trade. But as you can see, we just need to achieve our target 25 times to not lose anything and keep our net P&L to zero. These numbers change as we move down the table. As you can see, when we have a scenario of 1-to-5, our chances of reward are 5 times the risk that we're taking, and we just need to win approximately 17 times to break even. Now let's take an example that, if your analysis, technical and fundamental, gives you a win rate of 40%, which is pretty decent, we would say that increasing your risk to reward with this can get you tremendous results. We have again assumed that we've taken a total of 100 trades and the risk per trade is $10, but our win rate is fixed here at 40%. If the risk to reward ratio is 1-to-1, we're winning in 40% or in 40 of our trades, which means we've lost 60 times. Then our losses amount to $600 and our net loss is $200. We need a risk to reward ratio of 1-to-1.5 just to break even. As you can observe, as our risk to reward ratio increases as we move down the table, our net profit increases by a considerable amount as well because our losses are limited to $600. Take the case of the 1 to 5 risk to reward ratio. Our loss still amounts to $600, but our profits now amount to 40 times 50. 40 is our win rate and 50 is derived from the risk to reward ratio, where the reward is 5 times the risk. And we've assumed the risk per trade as 10. So the total profits that we can gain are $2,000, and our net profit comes to $1,400. In the diagram above, we can see the breakout happens around the price of $440, and we take a short selling position at the price of $437.29. If the price goes back up, we can take a loss, setting a stop loss at $459.87, limiting our loss to $22.58. But if the price still goes down as it did in the stock graph, we make a net profit of $35.81. Once the breakout happens, we have the opportunity to potentially make more than we can lose. And as it's visible in the graph, the big green rectangle represents our reward, and the big red rectangle represents the risk. And our loss had the price gone back up. Our risk to reward ratio in this scenario was 1 to 1.59. Let's look at another example. Contrary to the last graph, we take a long position here when the breakout happens around the price of $30. We enter the market with our long selling position at $31.97, but if the price goes back down, we set a stop loss at $29.87, limiting our loss to $2.10. As we can see in the stock chart, the price went up and we exited the market at $36.35, which gives us a net profit of $438. The big green rectangle represents our reward, and the not so big red rectangle represents our risk and the potential loss had the price gone down, which gives us a risk to reward ratio of 1 to 2.09. Risk allocation per trade. One of the main aspects of risk is determined by how much risk you take in a single trade. Risk per trade should always be a small percentage of your total capital. A good starting percentage could be 2% of your available trading capital. So, for example, if you have $5,000 in your account, the maximum loss allowable should be no more than 2%. It would limit your losses to a maximum of $100 per trade. A 2% loss per trade would mean that you can go wrong 50 times in a row before you blow up your capital. However, this is highly unlikely if you have a rational plan in place to make your trades. Number of opened positions. You can enter into a lot of trades and open multiple positions, but that isn't the end of things. Managing your positions is very important, even if you've implemented the risk allocation per trade of, let's say, 2% per trade, but you've opened around 20 positions. Well, that can lead to total 40% loss of your capital, which you may not be able to bear. To manage your number of positions, you must limit the overall risk that you're willing to take from all the open positions. Let me explain this with an example. Suppose you're willing to take up to 15% of risk of your overall capital, and you're taking 1.5% risk in each trade. Well, your open positions shouldn't exceed 10 at any time. Now, risk per trade might differ. Consider that in one of your trades you have a risk to reward of 1 to 1, so you only took 1% risk, but in another trade you see a risk to reward of 1 to 4, and you think that you can take up to 2% risk in this trade. So you always sum up the risk involved in all the open positions and you manage them accordingly. Position sizing. Your position sizing depends on your risk allocation per trade. Let's understand this by taking the help of another example. Consider this chart of Tesla stock at the daily time frame. We can see a triangle form between September and December. The breakout occurs on the upper side of the triangle around the price of $445, and that's a buy signal. Let's say you enter the market at $446.39 after the breakout when the candle gives a closing outside the pattern on a daily time frame. You should first set your stop loss below the previous swing or below the support trend line. Let's assume that you set your stop loss at $395.58. That sets your potential loss at 446.39 minus 395.38 or 50.81 per stock, which is around 12%. You can't keep buying this stock with 100% of your capital since the stop loss is around 12%. If you have capital of $50,000 and a risk per trade of 2%, you can only risk around $1,000. So you can only buy 1,000 divided by 52, which is 19 shares of Tesla, to stay within your defined risk levels. The cost of those 19 shares would amount to $8,500, which is only 17% of your capital. This is how you should go about managing your position sizing. Leverage. The last item on our bucket list is leverage, which also happens to be a big risk magnifier. We prefer to refer to this as leverage when you use another bank's or broker's money rather than your own. Now, the stock market is a very leveraged market in which you could put down a deposit of $1,000 to trade $5,000 or even $10,000. If you trade worth $10,000 with a deposit of $1,000, your leverage factor comes down to 10 to 1, which means even a 1% loss in a 10 to 1 leveraged situation will equal $100. Let's say the trade goes 1% against you. You'll lose 10% of your capital, just like that. This should explain to you the importance of position sizing and risk per trade. If you're new to trading, you might get excited to see that you can use 5x or 10x leverage, and you might start trading with a huge amount. However, you should always consider the consequences and always keep in mind that the leverage, of course, cuts two ways. You need to remember that leverage here is a two-way street. If you're leveraged and you make a profit, you'll see a big magnification in your returns. But consider an alternate situation as well. If you make losses, you will erode your account just as quickly.